There's a signal I'm watching right now that's never been wrong. Not once in 70 years. Every single time this signal has appeared, a recession has followed within 6 to 18 months. Every time. No exceptions. And it's flashing right now. I'm Michael Burry. I predicted the housing crisis when everyone said I was crazy. I saw the subprime mortgage collapse coming years before it happened. I bet billions against the housing market and made over 700% returns while the financial system nearly destroyed itself. I did that by ignoring the noise and focusing on data, on patterns, on signals that actually matter. And right now, I'm seeing a signal that tells me a recession is coming, not might be coming, is coming. The only question is when, and how severe. Today I'm going to explain exactly what this signal is, why it's never been wrong, what it's telling us about the economy right now, and what you need to do to protect yourself. Because most people have no idea what's coming. They're looking at the stock market hitting new highs and thinking everything is fine. They're listening to the Federal Reserve saying the economy is strong. They're hearing politicians talk about how well things are going, and they're completely missing the warning signs. Let me start by telling you about a moment that changed how I think about economic forecasting. It was 2005. I'd been studying the housing market for months, reading mortgage documents, analyzing loan files, looking at the actual borrowers behind these mortgage-backed securities. And I kept seeing the same thing: borrowers who couldn't afford their homes, loans that made no sense, adjustable rate mortgages with teaser rates that would reset to levels that would trigger immediate default. The entire structure was fraudulent. But when I tried to explain this to people, when I tried to short the housing market, everyone told me I was wrong. The rating agencies said these securities were AAA. The banks said housing prices never go down. The government said subprime was contained. The entire establishment said I didn't understand how modern finance worked. That risk had been sliced and diced and distributed so cleverly that nothing could go wrong. I ignored all of that. I focused on the data, on what borrowers actually earned, on what mortgages actually cost when rates reset, on what would happen when prices stopped rising and people couldn't refinance. The math was simple. These loans would default. These securities would collapse. A recession would follow. And I was right. But here's what I learned from that experience. The signals were there years in advance. If you knew what to look for, you could see it coming. The problem is, most people don't look at the right signals. They look at lagging indicators, things that tell you what already happened. Stock prices, GDP growth, unemployment rates. These are all lagging indicators. By the time they turn negative, the recession is already here. You've already lost money. It's too late to protect yourself. What you need are leading indicators, signals that change before the recession hits, signals that give you time to reposition, time to protect your capital, time to prepare. And the signal I'm watching now is the most reliable leading indicator I've ever found. It's called the yield curve inversion. Specifically, the spread between 10-year Treasury yields and 2-year Treasury yields. Let me explain what this means and why it matters. When you lend money to the government by buying Treasury bonds, you get paid interest. The interest rate, or yield, depends on how long you're lending the money. Normally, longer-term bonds pay higher yields than shorter-term bonds. This makes sense. If I'm lending you money for 10 years, I want more compensation than if I'm lending it to you for 2 years. There's more risk over a longer time period, more uncertainty. So the 10-year Treasury normally yields more than the 2-year Treasury, maybe 1 or 2 percentage points more. This is called a normal yield curve. It slopes upward. Short rates are low, long rates are high. But sometimes this inverts. The 2-year yield goes higher than the 10-year yield. The curve slopes downward. Short-term rates are higher than long-term rates. This is called a yield curve inversion. And when it happens, a recession always follows. Let me repeat that. Always. Since 1950, there have been 8 recessions in the United States. Before every single one, the yield curve inverted. Every time the yield curve inverted, a recession followed within 6 to 18 months. There have been no false positives, no times when the curve inverted and a recession didn't happen. This signal has a 100% track record over 70 years. Why does this work? Why does the yield curve inversion predict recessions so reliably? There are several mechanisms. First, an inverted yield curve reflects expectations about the future economy. Bond traders are smart. They have access to all the information. They analyze everything. When they bid up short-term rates higher than long-term rates, they're telling you something. They're saying they expect the economy to weaken. They expect the Federal Reserve to cut rates in the future. They expect lower growth and lower inflation ahead. So they're willing to accept lower yields on long-term bonds because they think that will be better than the yields available in a few years. Second, an inverted yield curve damages the financial system. Banks borrow short-term and lend long-term. That's their core business model. They pay depositors low rates on checking and savings accounts, which are short-term liabilities. They lend out that money in mortgages and business loans, which are long-term assets. They make money on the spread. If they're paying 2% on deposits and earning 5% on loans, they make 3%. That's their profit. But when the yield curve inverts, this model breaks. If short-term rates are higher than long-term rates, banks can't make money. They're paying more on deposits than they're earning on loans. This squeezes bank profitability. Banks pull back on lending. They tighten credit standards. They reduce loan growth. And when banks stop lending, the economy slows. Businesses can't get capital. Consumers can't get mortgages or car loans. Economic activity declines. Third, an inverted yield curve reflects Federal Reserve policy that's too tight. The Fed controls short-term rates through the federal funds rate. When they raise rates aggressively to fight inflation, they push short-term rates up, but long-term rates are set by the market. If the market thinks the Fed is overdoing it, that they're going to cause a recession, long-term rates stay low or even fall. The curve inverts. And then the recession happens because the Fed has tightened too much. Now let me tell you what's happening right now. The yield curve inverted in July of 2022. The 2-year Treasury yield went above the 10-year yield, and it stayed inverted for months, through late 2022 and into 2023. At its most extreme, the 2-year was yielding over 100 basis points more than the 10-year. That's a deep inversion, as severe as we've seen in decades. Then in late 2023 and into 2024, the curve started to steepen. The 10-year yield rose. The 2-year fell. The inversion ended. The curve returned to normal, and many people said, "See, no recession." The yield curve was wrong this time. It gave a false signal. The economy is fine. These people don't understand how the signal works. The recession doesn't happen during the inversion. It happens after the inversion ends, after the curve re-steepens. Let me show you the historical pattern. 1973, the curve inverted. Then it steepened. Then the recession hit in 1974 and 1975. One of the worst recessions of the post-war era. 1978 to 1979, the curve inverted, then it steepened. Then we got back-to-back recessions in 1980 and 1981 to 1982. Brutal recessions with unemployment over 10%. 1988 to 1989, the curve inverted. Then it steepened. Then the recession hit in 1990 to 1991. The Gulf War recession. 1998, brief inversion. 1999 to 2000, sustained inversion. Then the curve steepened. Then the dot-com recession hit in 2001. 2005 to 2006, the curve inverted. Then the curve steepened in 2007. Then the Great Recession hit in 2007 to 2009, the worst economic crisis since the Great Depression. 2019, the curve inverted briefly. It steepened. Then COVID hit and we got a recession in 2020. Every time, the same pattern, inversion, re-steepening, then recession. Now look at where we are. The curve inverted in 2022. It stayed inverted through 2023. It re-steepened in 2024 and into 2025. The signal has fired. The pattern has played out. We're now in the window where the recession typically arrives, 6 to 18 months after re-steepening. That puts us in the second half of 2025 or into 2026. The signal is telling us a recession is coming, soon. But here's what makes this particularly concerning. People are ignoring it. The stock market is near all-time highs. Consumer confidence is decent. The unemployment rate is low. The Federal Reserve is saying the economy is strong. They achieved a soft landing. They raised rates to fight inflation without causing a recession. They're declaring victory. And I'm telling you, they're wrong. The recession hasn't been avoided. It's been delayed. And when it hits, it's going to be more severe than people expect. Because the longer the delay between the signal and the recession, the more imbalances build up in the economy, the more vulnerabilities accumulate, and the worse the eventual downturn. Let me explain why this recession is going to be particularly bad. First, we have record levels of debt. Government debt is over $34 trillion. That's over 120% of GDP, higher than any time except World War II. Corporate debt is at record highs, over $13 trillion. Many companies loaded up on debt when rates were zero during the pandemic. Consumer debt is at record highs. Credit card balances are over $1 trillion. Auto loans are over $1.6 trillion. Student loans are over $1.7 trillion. This debt was manageable when interest rates were near zero, but rates have gone from 0 to 5%. The cost of servicing this debt has exploded. The federal government is now spending over $1 trillion per year just on interest payments. That's more than we spend on defense, more than we spend on most other programs. And it's growing every year as old debt issued at low rates gets refinanced at higher rates. Corporations that borrowed at 2 or 3% are now refinancing at 7 or 8%. This is crushing their cash flows. Many businesses that looked healthy at 0 rates are losing money at 5% rates. They'll default. They'll go bankrupt. Consumers maxed out their credit cards during the pandemic. They built up balances, and now they're paying 20% or more in interest. Credit card delinquencies are rising. Auto loan delinquencies are rising. People are struggling. When the recession hits, when unemployment rises, this debt becomes catastrophic. Defaults spike. Banks take losses. Credit tightens further. The recession deepens. Second, we have bubbles in multiple asset classes. Stock valuations are extremely high by historical measures. The S&P 500 is trading at over 25 times earnings. The median stock is even more expensive. We have AI stocks trading at absurd valuations, companies with no profits valued at tens or hundreds of billions. This is a bubble. When the recession hits, earnings will decline, valuations will contract, stock prices will fall. Real estate is also overvalued in many markets. Housing prices are at all-time highs relative to incomes. Commercial real estate is in trouble. Office buildings are half empty because of work from home. Retail is struggling because of e-commerce. These properties are worth far less than the mortgages secured by them. Banks are sitting on huge unrealized losses. When the recession hits, property values will fall further. More defaults. More bank losses. Cryptocurrency is still valued at trillions of dollars despite having no fundamental value. This will collapse in a recession. Private equity and venture capital have inflated valuations throughout the private markets. These will reset dramatically when the recession forces honest price discovery. When all these bubbles deflate simultaneously, the wealth destruction will be enormous. Trillions of dollars will evaporate. The negative wealth effect will cause consumers to pull back spending. The recession will deepen. Third, we have a fragile financial system. Yes, the big banks are better capitalized than they were in 2008, but there are vulnerabilities. Regional banks are struggling. They have large unrealized losses on their bond portfolios because rates rose. They have exposure to commercial real estate. Several failed in 2023. More will fail in the recession. The shadow banking system has grown enormously. Private credit, money market funds, non-bank lenders. These institutions don't have the same regulations or safety nets as banks. When the recession hits, some will fail. This could create contagion. Leverage is everywhere. Hedge funds use leverage. Private equity uses leverage. Corporations use leverage. When asset prices fall and leverage unwinds, it amplifies the decline. We saw this in 2008. We'll see it again. The financial system is also more interconnected than ever. Globalization. Derivatives. Complex securities. When something breaks somewhere, it spreads everywhere. The 2008 crisis started in subprime mortgages but spread to the entire global financial system. The next crisis could start anywhere: Chinese real estate, European banks, emerging market debt, and it will spread. Fourth, we have policy constraints. In previous recessions, the Federal Reserve had room to cut rates aggressively. In 2008, they cut from 5% to 0%. They did quantitative easing. They bought trillions in bonds. This helped stabilize the financial system and eventually restart growth. But now, if the recession hits soon, the Fed has limited ammunition. They're at 5% now. They could cut to 0%. That's 5 percentage points. In 2008, they cut 5.25 percentage points, so they have slightly less room. But more importantly, inflation is still above their 2% target. It's come down from the peak of 9%, but it's still around 3 to 4%. If they cut rates aggressively, inflation could reignite. They're trapped. They can't fight the recession without risking inflation. This is stagflation. Slow growth or recession combined with elevated inflation. This is the worst possible environment for policymakers. Fiscal policy is also constrained. The government is already running massive deficits, over $2 trillion per year. In a normal recession, you'd expect fiscal stimulus, tax cuts, government spending, unemployment benefits. But we're already spending like we're in a recession. The deficit is already enormous. There's no political will to increase it further. We're at the limits of fiscal capacity. So when the recession hits, policymakers won't be able to respond as effectively as they did in previous downturns. The recession will be deeper and longer. Let me tell you about some other signals that are confirming the yield curve message, because the yield curve isn't the only indicator flashing warning signs. The SOM rule is another recession indicator with a perfect track record. It was developed by economist Claudius SOM. The rule says that when the 3-month average of the unemployment rate rises by 0.5 percentage point or more above its lowest point in the prior 12 months, a recession has started. This has a perfect track record since 1970. Every time the rule has been triggered, a recession was underway. And we're getting close to triggering it now. The unemployment rate has been rising gradually, from a low of 3.4% to around 4%. If it continues rising to 3.9 or 4%, the SOM rule triggers. That tells us we're already in a recession. Leading economic index is another signal. The Conference Board publishes this monthly. It's a composite of 10 leading indicators. Things like new orders, building permits, stock prices, consumer expectations. When the LEI declines for an extended period, a recession typically follows. The LEI has been declining for months. It's down over 5% from its peak. This has preceded every recession. The pattern is clear. The CEO confidence index is also falling. When surveyed, CEOs are increasingly pessimistic about the economy. They're seeing slowing orders. They're seeing pressure on margins. They're pulling back on hiring and investment. This leads economic activity. Freight and logistics data is weakening. Trucking volumes are down. Rail carloads are down. This tells you real economic activity is slowing. You can manipulate financial data and statistics, but you can't fake physical goods moving around the country. When freight volumes fall, the real economy is contracting. Consumer behavior is shifting. People are trading down, buying cheaper brands, shopping at discount stores. This happens when they feel financial pressure. Credit card data shows spending is slowing, especially on discretionary items, travel, dining out, entertainment. People are pulling back. Corporate earnings are under pressure. Many companies are missing estimates. Revenue growth is slowing. Margins are compressing because of wage pressure and other costs. Guidance is being cut. This is what happens before a recession. Employment data is starting to weaken. Not just the unemployment rate rising, but other measures. Hours worked is declining. Temporary employment is falling. This often happens before layoffs. Job openings are down significantly from their peak. Hiring is slowing. The labor market is softening. All of these signals point the same direction. Recession is coming. Now let me address the counterargument. The optimists say the economy is resilient. Consumer spending is still solid. The labor market is still strong. Corporate profits are still high. GDP growth is still positive. They say this time is different. The yield curve signal won't work because of unusual factors. Quantitative easing distorted the curve. The pandemic created unusual conditions. The economy has changed. The old signals don't apply. I've heard all of this before. In 2006 and 2007, people said the same things. Housing prices will never fall nationally. Subprime is contained. The economy is strong. The old rules don't apply. They were wrong. The recession happened. It was devastating. The signals were right. The optimists who ignored them lost everything. The same will happen this time. Yes, every cycle has unique features. Yes, there are always reasons to think this time is different. But the fundamental dynamics don't change. Debt accumulates, bubbles inflate, imbalances build, and eventually they correct. The recession happens. Wealth is destroyed. The cycle repeats. Let me tell you specifically what I think happens next. We're in late 2025 now. The yield curve re-steepened in 2024. Based on historical patterns, the recession window is 6 to 18 months after re-steepening. That puts us in mid to late 2025, through the first half of 2026. I think we'll see clear signs of recession by the fourth quarter of 2025 or the first quarter of 2026. The unemployment rate will rise above 4% and keep rising. GDP growth will turn negative. Corporate earnings will decline. The stock market will fall. The Federal Reserve will cut rates, but it won't help quickly. Recessions take time to play out. I think this recession lasts through 2026 and possibly into 2027. It won't be as severe as 2008 because the banking system is stronger. But it will be worse than the mild recessions of 1990 to 1991 or 2001. We'll see unemployment rise to 6 or 7%. Stock markets will fall 30 to 40% from peak to trough, maybe more if we get a financial accident. Housing prices will decline 10 to 20% nationally, more in overvalued markets. Commercial real estate will get crushed. Many properties will lose 50% or more of their value. Corporate defaults will spike. We'll see bankruptcy filings surge. Companies that took on too much debt when rates were zero will fail, particularly in sectors like retail, commercial real estate, and leveraged buyouts. Banks will take losses. Regional banks will face stress. Some will fail or be acquired. The FDIC will be busy. Consumer distress will increase. Credit card defaults will surge. Auto repos will increase. People will struggle to pay their bills. Government deficits will explode. In a recession, tax revenue falls. Spending on unemployment benefits and social programs rises. The deficit could hit $3 or $4 trillion per year. This will cause concerns about fiscal sustainability. Bond yields might not fall as much as they normally do in a recession. If investors worry about U.S. creditworthiness, they'll demand higher yields. The Fed will be trapped. They'll cut rates. But if inflation stays elevated, they can't cut to zero. They might only cut to 3 or 4%. This won't provide enough stimulus. The recovery will be slow. It might take years for unemployment to return to pre-recession levels. This will be a difficult period. Economically, financially, politically, social tensions will increase. People will be angry. They'll look for someone to blame. Politicians, the Fed, corporations, the wealthy. This could lead to policy changes, higher taxes, more regulation, populist measures that make the economic situation worse. Now, let me tell you how to position yourself. Because if you understand what's coming, you can protect your wealth and potentially profit. First, reduce your exposure to risky assets. If you're heavily invested in stocks, especially overvalued growth stocks and speculative plays, reduce your position. Take some profits. Lock in gains while you can. I'm not saying go to 100% cash, but if you're typically 70% stocks, consider moving to 40 or 50%. Raise cash. Hold treasury bills. These are safe. The U.S. government won't default on short-term debt. You'll earn 5% risk-free. That's better than losing 30 or 40% in a stock market decline. Second, focus on quality. If you're going to own stocks, own high-quality companies. Companies with strong balance sheets, low debt, high profit margins, recession-resistant business models. Think consumer staples. Utilities. Healthcare. These sectors hold up better in recessions. Avoid highly leveraged companies. Avoid cyclical industries that get crushed in recessions. Avoid speculative growth stocks with no earnings. These will fall 70, 80, 90%. Third, avoid commercial real estate entirely. Don't own office REITs. Don't own retail REITs. Don't own commercial mortgage-backed securities. This sector is going to get destroyed. If you own property directly, consider selling now while you can still get a reasonable price. Values are going to fall. Fourth, be careful with bonds. Normally bonds do well in recessions because the Fed cuts rates and bond prices rise. But this time might be different. If inflation stays elevated, if fiscal concerns increase, bond yields might not fall much. Long-duration bonds could be risky. Stick to short-term treasuries, 1 to 3 year maturities, or just treasury bills. Fifth, hold physical gold, maybe 5 or 10% of your portfolio. Gold is insurance. It holds value when currencies are debased. When governments run massive deficits and central banks print money, gold preserves purchasing power. It's done that for thousands of years. In a recession with elevated inflation, gold will likely outperform. Sixth, keep some cash in physical form. Not everything in the bank. Banks can fail. We saw it in 2023. More will fail in the recession. Keep some cash at home, enough to cover a few months of expenses, just in case. Seventh, reduce personal debt. Pay down credit cards. Pay down auto loans. Refinance your mortgage if you can lock in a low rate. The less debt you have, the more resilient you are in a recession. If you lose your job, if your income declines, low debt gives you flexibility. Eighth, build up emergency savings. 6 months of expenses at minimum. 12 months is better. In a recession, job losses happen. It might take months to find new employment. You need a cushion. Ninth, invest in skills. In a recession, job security comes from being valuable, being irreplaceable. Make yourself more skilled, more knowledgeable, more useful to your employer. This protects you from layoffs. 10th, be patient. Don't try to time the exact bottom. Don't try to buy stocks the day the market bottoms. You'll be wrong. Instead, wait for clear signs that the recession is ending. Wait for unemployment to stop rising. Wait for the Fed to have cut rates and started talking about raising them again. Wait for corporate earnings to stabilize. Then start buying again. Slowly, gradually. Dollar cost average back into the market. This is how you build wealth through economic cycles. You protect capital during the downturn. Then you deploy capital when assets are cheap. Let me share one more historical lesson, because this is important. In 2007, I was fully invested in my subprime bet. I'd bought credit default swaps. I was paying premiums every quarter. And I was waiting for the crash. But 2007 came and the market kept going up. Housing prices kept rising. Everyone said I was wrong. My investors were furious. They wanted to pull their money. They said I didn't know what I was doing. The pressure was immense. But I knew the data. I knew what was in those mortgages. I knew the crash was coming. I just didn't know exactly when. So I held on. I stayed patient. I kept paying the premiums. And then, in late 2007, the cracks appeared. Defaults started rising. 2008 came. The crisis hit. And I made over 700% returns. The lesson is that being right isn't enough. You also need patience. You need conviction. You need the ability to withstand being early and being criticized. Most investors don't have this. They need to be right immediately. They need validation. They need the crowd to agree with them. But the crowd is usually wrong, especially at turning points. Right now, the crowd thinks the economy is fine, that the Fed achieved a soft landing, that the yield curve signal failed, that stocks can keep going up forever. The crowd is wrong. The recession is coming. The signals are clear. And if you position yourself now, if you protect your capital, if you wait patiently for opportunity, you'll come out ahead. You'll preserve wealth while others lose it. Then you'll have capital to deploy when assets are cheap. When everyone else is panicking and selling, let me give you one final warning. The most dangerous time is right before the recession hits, when everything seems fine, when the stock market is at all-time highs, when the news is positive, When economists are optimistic, this is when people get complacent. This is when they stop being careful. This is when they take on more risk because they think they're missing out. And then the recession hits, and they lose everything. Don't be that person. Pay attention to the signals. The yield curve inverted. It re-steepened. The pattern has played out. The recession is coming within the next 6 to 12 months, maybe sooner. The other indicators are confirming it. Unemployment rising. Leading indicators falling. Corporate earnings under pressure. Freight volumes declining. CEO confidence dropping. The labor market softening. It's all pointing the same direction. This isn't speculation. This isn't a guess. This is pattern recognition based on 70 years of data. The yield curve signal has never been wrong. It's not going to be wrong this time. The recession is coming. The only questions are when exactly and how severe. My best guess is we see clear signs by late 2025 or early 2026. The recession lasts through 2026 and possibly into 2027. Stock markets fall 30 to 40% or more. Unemployment rises to 6 or 7%. Corporate defaults spike. Commercial real estate collapses. Banks face stress. It's going to be painful. But if you're prepared, if you've protected your capital, if you're patient, you'll survive. And then you'll thrive when others are still recovering from their losses. Now, let me talk about some specific sectors and companies that are going to get absolutely destroyed in this recession. Because it's not enough to know a recession is coming. You need to know where the pain will be concentrated, where the vulnerabilities are, where to avoid putting your money. The most obvious sector is commercial real estate. I mentioned this earlier, but let me go deeper. Office buildings in major cities are sitting at 30 to 50% vacancy. Companies have figured out they don't need as much space. They've embraced hybrid work. They've downsized their footprints. And this is permanent. It's not going back to pre-pandemic levels. When I look at the numbers, when I see buildings that were valued at $500 million in 2019, now trading at $100 million, that's an 80% decline in value. And the mortgages on these properties? They're underwater, way underwater. The owners can't refinance. They can't cover debt service from rental income. They're going to default. And who holds these mortgages? Banks, regional banks especially. They're sitting on billions in commercial real estate loans that are going to default. Some banks will survive by raising capital and taking the losses. Others won't. We saw Silicon Valley Bank, First Republic, and Signature Bank fail in 2023. That was the warning shot. More failures are coming in the recession. Retail real estate is just as bad. Shopping malls are dying. Department stores are closing. The anchor tenants that drove traffic are gone. And when the anchors leave, the smaller tenants follow. Vacancy rates spike. Property values collapse. I've studied the patterns from previous retail bankruptcies. When a major retailer files for bankruptcy and closes stores, it creates a cascade effect. The mall loses foot traffic. Other tenants see their sales decline. They can't afford their rent. They close too. The mall enters a death spiral. Hundreds of malls have closed over the past decade. More will close in this recession. The properties will be worth a fraction of the mortgages secured by them. The lenders will take massive losses. Then there's multifamily, apartment buildings. This was supposed to be the safe sector. Everyone said people need a place to live. Rents would stay strong. Property values would hold up. But that's changing. Many markets are oversupplied. Developers built too aggressively during the pandemic. Austin has too much supply. Phoenix has too much supply. Nashville, Charlotte, Raleigh. All these Sunbelt cities that saw a massive population influx during the pandemic. Developers rushed to build. They overbuilt. Now vacancy rates are rising. Rents are falling. Property values are declining. And the loans? They're starting to show stress. When the recession hits and unemployment rises, more people will double up in housing. More will move back with family. Rental demand will fall. Vacancy rates will rise further. Rents will drop more. Many apartment buildings will be worth 30 or 40% less than they are today. The mortgages will default. More bank losses. Let me talk about the auto industry, because this is going to be a major source of stress. Auto loans are over $1.6 trillion. Average loan balances are near record highs. Average interest rates are over 7%. Monthly payments are crushing. The average monthly payment is over $700 for a depreciating asset that loses value the moment you drive it off the lot. And people are defaulting. Auto loan delinquencies are rising. Repossessions are increasing. When the recession hits, when people lose jobs, when income declines, auto loans default in huge numbers. Think about what happened in 2008 and 2009. Auto loan default rates went from 2% to over 5%. That's a tripling. We'll see similar or worse in this recession. Because the loan balances are higher, the interest rates are higher, the monthly payments are more burdensome. This creates a cascade. People default. Banks repossess cars, they sell them at auction. This floods the used car market. Used car prices collapse. This destroys the collateral value on all the performing loans. A loan that had a loan-to-value ratio of 80% suddenly has a ratio of 120%. The car is worth less than the loan. If the borrower defaults, the bank loses money. This weakens bank balance sheets. They pull back on lending. Auto sales decline. The auto manufacturers see revenue fall. They lay off workers. This increases unemployment. The recession deepens. Credit card debt is another ticking time bomb. Over $1 trillion in credit card balances. Average interest rates over 20%. People maxed out their cards during the pandemic. They've been making minimum payments, barely covering the interest. The principal isn't declining. And now they're running out of room. Their credit limits are reached. They can't borrow more. When the recession hits, when income declines, they can't make payments. They default. Credit card charge-off rates are going to spike. They're already rising, currently around 4%. In a recession, they could go to 8 or 10%. Banks are going to take billions in losses on credit card portfolios. This will hit the major issuers hard. Bank of America, Chase, Citigroup, Capital One, Discover, they all have massive credit card exposure. Their earnings will get crushed. Their stock prices will fall. And they'll tighten credit standards. They'll cut credit limits. They'll stop issuing new cards. This will reduce consumer spending further. The recession accelerates. Student loans are another issue. $1.7 trillion in outstanding balances. Payments resumed after the pandemic pause. Many borrowers are struggling. Default rates are starting to rise. In a recession, with unemployment up, defaults will surge. Now, most student loans are federal. The government holds them. Private lenders aren't as exposed. But it still matters. When people are using significant income to service student debt, they can't spend on other things. Consumption falls, the economy slows, and there's political pressure to forgive student debt. If that happens, it adds to the federal deficit. It reduces future government revenue. It creates more fiscal stress. Either way, student loans are a drag on the economy. They reduce consumption. They make the recession worse. The banking sector broadly is vulnerable. Yes, the big banks are better capitalized than 2008, but they have issues. Unrealized losses on bond portfolios. When rates rose from 0 to 5%, the value of bonds they bought during the pandemic collapsed. These losses are on the balance sheet even if they're not realized. They reduce the equity cushion. They make banks fragile. Commercial real estate exposure. Many banks, especially regional banks, have significant CRE loans. These are going to default. Office, retail, multifamily. It's all stressed. Some banks have 20, 30, even 40% of their loan book in commercial real estate. When defaults hit, when losses mount, capital ratios will fall. Some banks won't survive. Consumer loan exposure, auto loans, credit cards, mortgages, all will see rising defaults in the recession. Banks will take losses across their portfolios. Then there's the risk of deposit flight. When people get scared, when they think their bank might fail, they pull deposits. We saw this with Silicon Valley Bank. $16 billion withdrawn in one day. The bank collapsed. In a recession, more banks will face runs. Some will survive, others won't. And the FDIC only insures up to $250,000 per depositor. If you have more than that in one bank, you're at risk. Sophisticated depositors know this. They spread money across multiple banks, or they move to treasury bills. This creates more pressure on banks. Let me talk about specific companies that are in serious trouble. I'm not going to name every company, but I'll give you patterns. Companies with high debt and low margins. These get crushed in recessions. Revenues decline. Costs stay high. They can't cover interest payments. They default. Look for companies with debt to EBITDA ratios above 4 or 5. Look for interest coverage below 2. These are walking dead. Companies in cyclical industries, industrials, materials, discretionary consumer goods. When the economy contracts, demand for these products falls hard. Earnings disappear. Stock prices collapse. Airlines are always vulnerable. They have high fixed costs. Fuel costs are volatile. Demand is cyclical. In recessions, people stop flying for leisure. Business travel declines. Load factors fall. Airlines lose money. Some go bankrupt. This happens every recession. Retailers are vulnerable, especially department stores and apparel. When consumers feel financial pressure, they cut spending on clothing and discretionary goods. Retailers see sales decline. They can't cover their store costs. They close locations. Some go bankrupt. We've seen this repeatedly. Restaurants and hospitality. When people lose jobs or fear losing jobs, they stop eating out. They stop traveling. Restaurants see traffic decline. Hotels see occupancy fall. Many operate on thin margins. They can't survive a prolonged downturn. Commercial construction companies. When commercial real estate crashes, new construction stops. These companies lose their revenue, they lay off workers, some go bankrupt. Let me tell you about the leveraged buyout sector, because this is going to be catastrophic. Private equity firms bought thousands of companies over the past decade using borrowed money. They paid premium prices. They loaded the companies with debt. The plan was to improve operations, grow revenues, and sell for a profit. But many of these deals were done at the peak. They paid too much. The operational improvements aren't delivering. The revenue growth isn't materializing. And now the debt is crushing them. These companies borrowed at low rates, 2, 3, 4%. Now they need to refinance at 7, 8, 9%. The interest expense doubles or triples. Companies that were marginally profitable are now losing money. They can't cover debt service. They're going to default. And the debt? It's packaged into collateralized loan obligations, CLOs. These are securities backed by pools of leveraged loans. They're sold to investors. Banks, insurance companies, pension funds. They all own CLOs. When the underlying loans default, the CLOs lose value. This creates losses throughout the financial system. It's eerily similar to what happened with mortgage-backed securities in 2008. Except instead of mortgages, it's corporate loans. And the losses could be enormous. There's over $1.5 trillion in leveraged loans outstanding, much of it packaged into CLOs. If default rates spike from 2% to 8 or 10% in a recession, that's 100 to 150 billion in losses. This will hit lenders, investors, and the broader financial system. Now let me address the elephant in the room, the federal government's finances, because this is the biggest long-term problem, and it makes the coming recession even more dangerous. Federal debt is $34 trillion. That's 120% of GDP. The deficit is $2 trillion per year in peacetime with low unemployment. This is unprecedented. Normally you run deficits in recessions and wars. You run surpluses or balanced budgets in good times. We're running massive deficits during an expansion. What happens in the recession? Revenue falls. Corporate taxes decline because profits fall. Individual income taxes decline because people lose jobs and incomes fall. Capital gains taxes decline because asset prices fall. At the same time, spending increases. Unemployment benefits, food stamps, Medicaid, all the safety net programs see more people enrolling. The deficit explodes. It could go to $3 or $4 trillion per year. Maybe more if there's fiscal stimulus. And the debt? It keeps growing. It could hit 40 trillion by the end of the decade. At some point, this becomes unsustainable. Investors start worrying about whether the U.S. can service its debt. They demand higher yields. Interest rates rise. This makes the deficit worse because the government has to pay more interest. It's a vicious cycle. I don't think we default. The U.S. controls its own currency. The Fed can always print money to pay debt, but that causes inflation. It destroys the purchasing power of the dollar. It's a hidden default. Either way, the fiscal situation is going to create problems. It limits policy options in the recession. It creates uncertainty for investors. It makes the economic situation more difficult. Let me tell you about what happens to the average American in this recession. Because it's not just about markets and banks and corporate defaults. It's about real people, about families, about communities. When the recession hits, unemployment rises, people lose their jobs. Not everyone, not all at once, but gradually. First it's layoffs in cyclical industries, construction workers, manufacturing workers. Then it spreads to services, retail workers, restaurant workers, hotel workers. Eventually it hits white-collar workers, middle managers, professionals, even some executives. When you lose your job, your income stops. You need to tap savings if you have them. Most Americans don't have significant savings. The median household has less than $5,000 in savings. That covers maybe 2 months of expenses if you're frugal. After that, you start making hard choices. Do you pay the mortgage or buy food? Do you make the car payment or pay for health insurance? Do you put it on credit cards and hope you find a job before you max them out? Many people go through their savings, then max out credit cards, then start missing payments. The mortgage first, because it takes months for the bank to foreclose. Then the car payment, because you need the car to look for work. Eventually, everything is past due. Collections agencies start calling. Your credit score collapses. This affects your ability to rent an apartment, get insurance, sometimes even get hired. The stress is enormous. Marriages break up under financial pressure. Health problems emerge from stress. People fall into depression. Suicides increase in recessions. This is documented. The human cost is real and devastating. For people who keep their jobs, life gets harder too. Employers freeze wages. They cut bonuses. They eliminate benefits. They increase workloads because they're not replacing people who left. You're doing the work of 2 or 3 people for the same pay. You can't complain because you're grateful to still have a job. You see your colleagues get laid off and you wonder if you're next. The anxiety is constant. You stop spending. You hunker down. You save every dollar because you don't know what's coming. This reduction in spending by people who are still employed makes the recession worse. Consumer spending is 70% of the economy. When everyone pulls back simultaneously, GDP falls. More companies struggle. More layoffs happen. The cycle continues. For retirees, recessions are particularly brutal. If you're retired and living off your portfolio, a 30 or 40% decline in stock prices is devastating. Your nest egg that was $2 million is now $1.2 million. You were withdrawing $80,000 per year to live on. That was 4% of $2 million, but it's 6.7% of $1.2 million. That withdrawal rate is unsustainable. You're going to run out of money. So you cut spending. You stop traveling. You reduce your lifestyle. You live in fear that your money won't last. For young people, recessions destroy opportunities. You graduate college into a recession. There are no jobs. You can't get experience. You can't start your career. You end up taking work you're overqualified for just to survive. This sets back your earning trajectory for years. Studies show that people who graduate into recessions earn less throughout their careers compared to those who graduate in good times. The timing of your entry into the workforce matters enormously, and it's completely out of your control. Let me talk about regional variations. Because recessions don't hit everywhere equally. Some places get destroyed, others weather it reasonably well. Cities and states that depend on cyclical industries get hit hardest. Detroit in manufacturing recessions, Houston in oil busts, Las Vegas when travel and entertainment collapse, Florida when real estate crashes. These places see massive unemployment. House prices collapse. State and local tax revenues fall. Services get cut. Schools, police, infrastructure all suffer. It becomes a downward spiral. People leave. They move to where there are jobs. This reduces the population, further reduces tax revenue, makes things worse. Some cities never fully recover. They end up smaller, poorer, less dynamic than before. Cities with diverse economies do better. Places with major universities, healthcare, government, technology. Boston, Austin, Seattle, Washington, D.C. They still have recessions, but they're not as severe. People have more options, more industries to work in. The recovery comes faster. The wealth effect from housing is also regional. In 2008, Phoenix and Las Vegas saw housing prices fall 60%. People lost everything. Their homes were worth half what they paid. They owed more than the house was worth. They walked away. Foreclosures everywhere. Neighborhoods became ghost towns. Other places, like Texas, saw much smaller declines. The recession was painful but not catastrophic. Same thing will happen in this recession. The Sunbelt cities that saw rapid appreciation during the pandemic. Phoenix, Austin, Nashville, Charlotte, Boise. These will see significant price declines, maybe 30 to 40%. The coasts, which didn't appreciate as much, might only see 10 to 20% declines. Still painful, but not catastrophic. Now, let me tell you about the international dimension. Because we don't live in a closed economy, what happens abroad matters. China is slowing dramatically. Their real estate bubble is bursting. Evergrande and Country Garden defaulted. They're the two largest developers. They have hundreds of billions in debt. Millions of apartments sitting empty. Property prices are falling. Chinese consumers are pulling back spending because they feel poorer. 70% of household wealth is in real estate. When property values fall, consumption falls. This is creating a deflationary spiral. Weak demand, falling prices, falling profits, rising unemployment. The government is trying to stimulate, but it's not working. They've cut interest rates. They've increased infrastructure spending. But consumers won't spend. They're scared. They're saving. This is China's version of Japan's lost decades. And it matters for the global economy. China is the world's second largest economy. It's a massive consumer of commodities, machinery, technology. When China slows, it hits exporters everywhere. Australia depends on iron ore exports to China. Brazil depends on soybeans. Germany depends on machinery exports. All of these countries will suffer. Europe is also weak. Germany is in recession. France is stagnating. The UK is barely growing. The European Central Bank raised rates to fight inflation. This slowed their economies. Now they're trying to cut rates, but it's too late. Europe is going into recession, and their banks are vulnerable. They have exposure to real estate. They have exposure to government debt from weak countries. Italy, Spain, Greece. If there's a crisis, these bonds fall in value. European banks take losses. This could trigger a broader financial crisis. Emerging markets are also at risk. Many countries borrowed heavily in dollars. When the dollar strengthens, which it does in global recessions, their debt becomes more expensive to service. Some countries will default. We saw this in previous crises. Argentina defaulted repeatedly. Turkey is struggling. Pakistan is struggling. Sri Lanka defaulted recently. In a global recession, more countries will have problems. This creates instability, political turmoil, sometimes revolutions. This affects global trade. It affects commodity prices. It affects everything. The point is that this recession is not just an American phenomenon. It's global. The yield curve is inverting or has inverted in multiple countries. The signals are flashing everywhere. This will be a synchronized global recession, and because everyone goes down together, there's no one to pull anyone else up. In 2008, China stimulated aggressively. They spent trillions on infrastructure. This helped the global economy recover. They won't do that this time. They can't. They're dealing with their own crisis. So the global recession will be deeper and longer than if we had one strong economy to help. Let me talk about the policy response. Because the Federal Reserve and the government will do things. They won't just sit there and watch the economy collapse. But their options are limited. The Fed will cut rates. They're at 5% now. They can go to 0. That's 5 percentage points of cuts. Normally, this would be enough to stabilize things. But inflation is still elevated. It's come down from 9%, but it's still around 3 to 4%. If they cut too aggressively, inflation could come back. They're trapped between fighting the recession and fighting inflation. They can't do both. My guess is they prioritize the recession. They'll cut rates even if it risks some inflation. But they won't cut to zero as quickly as they did in 2008. They'll be cautious. This means monetary policy will be less effective. The economy will take longer to recover. The Fed will also do quantitative easing. They'll buy treasury bonds and mortgage-backed securities. This injects money into the financial system. It's supposed to lower long-term interest rates and encourage lending, but it doesn't always work. In Japan, they've done QE for decades, and it hasn't ended deflation. In Europe, same thing. QE is not a magic bullet. It helps at the margin, but it can't solve fundamental problems. If consumers and businesses don't want to borrow because they're scared, you can't force them. You can't make people take on debt. The fiscal response will be massive deficits. The government will extend unemployment benefits. They'll send stimulus checks. They'll bail out industries. They'll spend on infrastructure. All of this adds to the deficit. We could see $3 or $4 trillion annual deficits during the recession. This will push total debt toward $40 trillion. At some point, this creates concerns about sustainability. Are we becoming Japan? Are we becoming Greece? Can we service this debt? These questions will start being asked. Not immediately, but as the debt grows. As the deficit stays large, eventually bond markets will push back. They'll demand higher yields. This will make the debt problem worse. It's a vicious cycle. There might also be bailouts. If major banks fail, the government will bail them out. We saw this in 2008. Too big to fail. If automakers are failing, the government might bail them out. We saw this in 2009 with GM and Chrysler. Politically, bailouts are unpopular. People hate seeing tax money go to corporations while they're losing their jobs and homes. But policymakers argue that letting major companies fail would make things worse. The debate will be fierce. Populist politicians will oppose bailouts. Centrist technocrats will support them. Eventually, bailouts probably happen, but with conditions. The bailed out companies have to restructure. Management gets fired. Shareholders lose value. It's messy and painful. Now let me talk about what happens after the recession. Because it's not all bad news forever. Eventually, recessions end. The economy recovers, new cycles begin. But recovery takes time. It's not V-shaped. It's U-shaped or L-shaped. The bottom lasts for a while. Unemployment stays elevated. People stay cautious. Companies don't hire until they're sure demand is recovering. Banks don't lend until they're sure borrowers can repay. Everyone is scared from what just happened. This slows the recovery. In 2009 and 2010, we were in recession or barely out of recession. Unemployment was 9 to 10%. It stayed above 8% for years. It didn't get back to pre-crisis levels until 2017. 8 years, that's a long time. A lot of pain over 8 years. This recovery might be similar. Unemployment could peak at 7% and stay above 5% for years. Stock markets recover faster than the real economy. They're forward-looking. They bottom when things look darkest. When everyone is terrified, when people think the world is ending. That's when stocks bottom. Then they start climbing. Slowly at first. Then faster. By the time the economy is actually recovering, stocks are up 50 or 100% from the bottom. This is why waiting for the economy to recover before buying stocks is a mistake. You miss the whole move. You have to buy when things look terrible, when you're scared, when it feels wrong. That's when you make money. Real estate recovers slowly, slower than stocks. Housing prices might bottom 2 or 3 years into the recession. Then they stay flat for years. Eventually they start rising again. But it takes time. In 2009, housing prices bottomed in many markets, but they didn't recover to 2006 levels until 2015 or later. 9 years, some markets still haven't fully recovered. Commercial real estate takes even longer. Office buildings that are half empty might stay half empty for a decade. The properties are worth less now. That's just reality. Retail properties that lost anchor tenants might never get them back. The buildings might be repurposed or torn down. The recovery in commercial real estate is very slow and very painful. For people who lost jobs, recovery is personal. If you're unemployed for 6 months or a year, you lose skills. Your network gets stale. It's harder to find work. You might have to switch industries, take a pay cut, start over. This affects your lifetime earnings. It affects your retirement savings. It affects your family's security. The emotional and psychological toll is real. Depression, anxiety, relationship problems, these don't just go away when you find a new job. They linger. People who live through severe recessions are scarred. They become more cautious, more savings focused, less willing to take risks. This affects their behavior for decades. Let me tell you what you should be doing right now, today, to prepare. Not next month, not when the recession is obvious. Now, because by the time it's obvious, it's too late. First, get your personal finances in order. Make a budget. Track every dollar. Know exactly what you're spending. Identify what you can cut if you need to. Most people have no idea where their money goes. They just spend and hope it works out. You can't do that. You need clarity and control. Pay down high-interest debt. Credit cards especially. If you're paying 20% interest, that needs to be priority one. Every dollar you pay down saves you 20 cents per year in interest. That's a guaranteed return, better than almost any investment. Build emergency savings, 6 months minimum. 12 months if possible. This goes in a high-yield savings account or treasury bills. Somewhere safe and liquid. You need this cushion. Most people don't have it and they're living paycheck to paycheck. One job loss and they're in trouble. Don't be that person. Review your insurance. Health, life, disability, property. Make sure you're adequately covered. The cost of not having insurance when you need it is catastrophic. One medical emergency without insurance can bankrupt you. One disability without insurance can destroy your financial future. Pay for proper coverage. Diversify income sources if possible. Side hustles. Freelance work. Multiple clients if you're a consultant. The more income streams you have, the more resilient you are. If one disappears, you have others to fall back on. Second, audit your investments. Look at what you own. Is it appropriate for a recession? If you're 70% stocks, and they're mostly growth stocks and speculative plays, you're going to get crushed. Reduce exposure. Take profits. Lock in gains. Move to cash. I know it's hard psychologically. You've made money. You don't want to sell. You think it will keep going up. But that's greed talking. Overcome it. Protect your capital. Review your 401k allocation. Most people just set it once and never look at it again. Look at it. If you're in target date funds, understand what they own. Many target date funds are still heavily in stocks, even for people close to retirement. This is dangerous. You might need to override the target date fund and choose a more conservative allocation. If you have a financial advisor, have a serious conversation. Ask them about their recession planning. What's the plan if stocks fall 40%? How will they protect your capital? Many advisors don't have a plan. They just ride the market up and down. They collect fees either way. But you suffer the losses. If your advisor doesn't have a good answer, find a new advisor. Or manage it yourself. It's not that complicated. Look at your real estate exposure. If you own rental properties in overvalued markets, consider selling. Yes, you'll pay capital gains taxes, but you'll lock in profits before prices fall. Better to pay taxes on gains than suffer losses. If you own your primary residence and you're planning to downsize or relocate anyway, consider doing it now, before the recession, while prices are still high. Third, career planning. Make yourself more valuable at work. Take on important projects. Develop new skills. Build relationships with management. Be the person they can't afford to lose. When layoffs come, the marginal employees go first. The people who are critical stay. Be critical. Build your professional network. Connect with people in your industry. Stay in touch. Go to conferences and events. If you lose your job, your network is how you find the next one. The stronger your network, the faster you'll land. Update your resume. Even if you're not job hunting, keep it current. Have it ready. If you suddenly need it, you don't want to be starting from scratch. Consider shifting industries. If you're in a cyclical industry that gets crushed in recessions, think about moving to a more stable industry. Healthcare, utilities, government, education. These are more recession resistant. Make the move now while times are good. Don't wait until you're desperate. Invest in education and skills. Take courses. Get certifications. Learn new technologies. The more skilled you are, the more valuable you are. The more valuable you are, the more secure your job is, and the faster you can find a new one if needed. Fourth, mental and emotional preparation. Understand that this is coming. Accept it. Don't deny it. Don't hope it won't happen. It's happening. The signals are clear. Prepare yourself mentally for difficult times, for seeing your portfolio decline, for possibly losing your job or seeing people around you lose theirs, for economic stress and uncertainty. Talk to your family. Make sure everyone understands the situation. That belts might need to tighten. That sacrifices might be necessary. Get everyone on the same page. This reduces conflicts and stress later. Maintain perspective. Recessions are temporary. They end. The economy recovers. Life goes on. Yes, it's painful. Yes, people struggle. But we've been through this before. We'll get through it again. Don't catastrophize. Don't think it's the end of the world. It's not. It's a difficult period that requires adjustment. Build resilience. Develop stress management techniques. Exercise, meditation, hobbies. Whatever works for you. You're going to need these tools. The stress will be real. Having ways to cope will make a huge difference. Fifth, look for opportunities. I know that sounds callous when we're talking about recession and job losses and suffering, but the reality is that recessions create opportunities for people who are prepared. Real estate becomes cheap. You can buy properties at huge discounts. Rental yields go up because prices fall while rents stay relatively stable. If you have cash and a secure income, buying real estate in a recession can set you up for decades. Stocks become cheap. Quality companies that were overvalued become reasonably valued or even undervalued. This is when you buy. When everyone is scared. When people think stocks will never recover. That's when you back up the truck and load up. Businesses become available. In recessions, businesses fail. Owners give up. You can buy businesses for fractions of what they're worth. Maybe it's a local restaurant or retail shop. Maybe it's a competitor in your industry. If you have capital, you can acquire assets cheap. Talent becomes available. Good employees get laid off through no fault of their own. Their companies failed or cut costs. If you're hiring, you have access to better talent at lower costs than in boom times. The key to all of this is being prepared. Having capital, having cash, having a secure income. If you're stretched thin, if you're barely making ends meet, you can't take advantage of opportunities. You're just trying to survive. But if you're in a strong position, recessions are when fortunes are made. Let me close with this. The recession signal is flashing. The yield curve inverted and re-steepened. This has predicted every recession for 70 years with perfect accuracy. The other indicators are confirming it. Unemployment rising, leading indicators falling, corporate earnings under pressure, credit stress building. The pattern is clear. The recession is coming. Probably late 2025 or early 2026. It will last through 2026 and possibly into 2027. It will be painful. Unemployment will rise. Asset prices will fall. Companies will default. Banks will face stress. People will suffer. But if you're prepared, if you've taken the steps I outlined, you'll survive. And you'll be positioned to thrive when it's over. This is what I did in 2008. I saw the signals. I positioned accordingly. I made over 700% returns, while others lost everything. I'm not lucky. I'm not a genius. I just pay attention to the data. I follow the signals. I act when others are complacent. You can do the same. The information is available. The signals are flashing. The question is whether you'll pay attention, whether you'll act, whether you'll prepare, or whether you'll ignore it like most people, like the people who ignored the housing bubble, like the people who ignored every bubble and recession signal in history. They always think it's different this time. They always think the signals don't apply. They always get destroyed. Don't be them. Be prepared. Be smart. Be disciplined. Protect your capital. Position for opportunity. And you'll come out ahead when this is over, because the recession signal is flashing, and it's never been wrong.